Preparing for a Boeing Cost Analyst interview? You've reached Candy Mentor, and this video is for you. We'll walk through 25 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does a cost analyst do on an aerospace program? A cost analyst converts program data into decisions. I would establish budgets, track actual costs, analyze labor, material, and overhead variances, update forecasts, and explain risks to program managers and finance leaders. On an aerospace program, accuracy matters because long development cycles, fixed-price contracts, engineering changes, and customer milestones can magnify small issues. I would partner with engineering, procurement, manufacturing, and accounting, while documenting assumptions and escalating unfavorable trends early rather than simply reporting historical results. While answering, focus on budgeting, forecasting, variance analysis, cost reporting, data integrity, cross-functional partnership, and how accurate analysis supports program profitability, schedule performance, customer commitments, and Boeing's safety-focused operating environment. Question 2. How would you build a cost estimate for a new Boeing program? I would begin with the statement of work and develop a work breakdown structure that identifies deliverables, activities, and responsible owners. Then I would estimate labor hours, rates, materials, supplier costs, tooling, overhead, schedule, inflation, and contingency using comparable programs and bottom-up inputs. I would document assumptions, test sensitivity to volume or timing changes, reconcile the estimate to contract funding, and review it with engineering, supply chain, operations, and finance before presenting a controlled baseline. Make sure to cover the work breakdown structure, historical data, labor and material estimates, overhead rates, schedule assumptions, risk and uncertainty, escalation, supplier inputs, management review, and reconciliation to funding or contract requirements. Question 3. Explain the difference between a budget, forecast, and actual cost. The budget is the approved financial baseline for planned work. Actual cost is what the accounting system records as incurred. The forecast is my latest estimate of where total cost will finish, incorporating actual results, remaining work, current assumptions, and known risks. Comparing actuals with budget explains performance to date, while comparing the forecast with budget highlights expected overrun or underrun. That distinction helps management act before a future problem becomes a final program result. In your answer, distinguish the approved baseline from the latest expected outcome and recorded spending, explain timing, accountability, forecast updates, variance analysis, and why the differences matter for program decisions. Question 4. How do you perform a meaningful cost variance analysis? I first quantify the variance and determine whether it is favorable or unfavorable against the relevant baseline. Then I separate price, quantity, labor efficiency, rate, schedule, volume, and timing effects instead of labeling everything as spending variance. I validate the data with the cost owner, identify the operational root cause, assess whether it is recurring, and update the forecast if necessary. Finally, I communicate the impact, owner, corrective action, and expected resolution date. Be sure to mention favorable and unfavorable variances, materiality, root cause investigation, price, usage, rate, volume, and timing drivers, corrective actions, trend analysis, and concise communication to decision makers. Question 5. What would cause a labor cost variance, and how would you investigate it? Labor variance can result from hours exceeding plan, higher wage rates, overtime, an unfavorable skill mix, schedule changes, productivity issues, rework, or inaccurate time charging. I would compare planned and actual hours by work package, labor category, and period, then review staffing and production data with the responsible manager. I would also check whether accounting timing or late timesheets distorted the result. The conclusion should identify a specific operational cause and a revised estimate for remaining work. Focus on hours, labor rates, staffing mix, overtime, productivity, rework, learning curves, charging practices, schedule shifts, and collaboration with supervisors to distinguish accounting timing from genuine operational performance. Question 6. How would you analyze a material cost variance? I would decompose material variance into purchase price, quantity usage, scrap, mix, timing, and engineering change effects. I would compare purchase orders, receipts, inventory issues, production records, and standard or planned costs. Supplier price increases may explain one portion, while excess consumption or rework may indicate an operational problem. I would confirm the cause with procurement and manufacturing, assess whether it affects remaining units, and update the estimate only after separating one-time timing effects from recurring cost pressure. Make sure to cover purchase price, quantity usage, scrap, substitutions, engineering changes, inventory timing, supplier performance, standard costs, and whether the variance represents a temporary timing issue or lasting estimate change. Question 7. What is earned value management, and why is it useful at Boeing? Earned value management integrates scope, schedule, and cost. Planned value measures authorized work scheduled, earned value measures the budgeted value of work actually completed, and actual cost captures spending. Cost variance equals earned value minus actual cost, while schedule variance equals earned value minus planned value. Indices such as CPI and SPI provide trend indicators. On complex aerospace programs, EVM gives leaders an objective early warning system rather than relying only on cash spending or subjective progress updates. In your answer, explain planned value, earned value, actual cost, schedule and cost variances, performance indices, objective progress measurement, and how EVM supports early warning on complex long-cycle programs. Question 8. How would you calculate and interpret CPI and SPI? CPI is earned value divided by actual cost, so a result below 1 indicates the program is receiving less budgeted value per dollar spent. SPI is earned value divided by planned value, with a result below 1 indicating progress is behind plan. For example, a CPI of 0.90 suggests approximately 90 cents of planned value per dollar spent. I would not stop at the metric. I would investigate drivers, assess whether trends are temporary, and connect them to the estimate at completion. Be sure to state the formulas, explain values above or below 1, distinguish efficiency from dollars remaining, and connect interpretation to root cause analysis, forecast implications, and management action. Question 9. How do you prepare a monthly program cost report? I would close the reporting period by validating actuals, commitments, accruals, labor charges, and interface data. Then I would compare current results with budget and prior forecast, calculate key variances and EVM indicators, and obtain explanations from cost owners. The report should show forecast at completion, major risks, corrective actions, and decision points, not just tables. I would reconcile totals to the general ledger, control versions, and tailor the summary so leaders can act quickly. Focus on data validation, actuals, commitments, budget, forecast, variances, EVM metrics, risks, corrective actions, version control, and tailoring the message to executives, program managers, and functional owners. Question 10. What is an estimate at completion, and how would you calculate it? Estimate at completion is the expected total cost when the program finishes. The most reliable approach is actual cost to date plus a bottom-up estimate to complete, because it incorporates current operational knowledge. In stable situations, I might use performance-based formulas such as BAC divided by CPI, or actual cost plus remaining budget adjusted for a performance factor. I would compare methods, investigate differences, document assumptions, and use the bottom-up view when scope, schedule, or risks have materially changed. In your answer, define EAC, discuss actual cost plus estimate to complete, explain performance-based formulas, validate assumptions, and describe when independent estimates should replace mechanical calculations. Question 11. How would you create an estimate to complete for remaining program work? I would start by confirming the remaining scope and status of each work package. For labor, I would assess remaining hours, staffing, rates, productivity, and schedule. For materials and suppliers, I would review open purchase orders, expected receipts, escalation, and likely changes. I would include tooling, overhead, testing, and risk allowances where appropriate. Each estimate would have an accountable owner and documented assumptions. I would reconcile the total to the baseline and challenge unsupported optimism before approval. Mention remaining scope, work packages, staffing, material requirements, supplier commitments, schedule, productivity, risks, escalation, current actual performance, and review with accountable functional owners. Question 12. How do you ensure costs are assigned to the correct work breakdown structure? I would begin with a clear work breakdown structure, charge number hierarchy, and mapping of each code to authorized scope and responsible owners. I would validate time, material, purchase order, and accounting transactions through exception reports and periodic reconciliations. Unusual charges, inactive codes, and overhead postings deserve investigation before month-end reporting. I would correct errors through documented journal or transfer procedures, identify recurring training issues, and preserve an audit trail so cost trends remain reliable and defensible. Make sure to cover coding structures, charge numbers, scope ownership, timekeeping controls, mapping tables, system validation, exception reports, training, and correction of mischarges before reporting is finalized. Question 13. How would you evaluate a make versus buy decision? I would compare the supplier quote with relevant internal incremental costs, including direct labor, material, variable overhead, tooling, inspection, logistics, and any avoidable fixed costs. I would also evaluate capacity constraints, quality, schedule, supplier reliability, intellectual property, technology, and lifecycle support. Allocated fixed costs should not drive the decision if they remain regardless of the choice. I would present sensitivities for volume, escalation, and learning effects, then recommend the option with the strongest total economic and operational outcome. Discuss relevant incremental costs, avoidable fixed costs, supplier pricing, capacity, quality, schedule, intellectual property, risk, lifecycle economics, and strategic considerations rather than comparing only quoted prices. Question 14. How do engineering changes affect cost analysis? An engineering change can affect design labor, tooling, material usage, rework, scrap, testing, suppliers, and schedule. I would identify the changed requirements, determine which work packages and units are affected, and estimate both one-time and recurring impacts. I would check for obsolete inventory, open orders, and customer authorization where relevant. After approval, I would update the baseline or change control record, revise the forecast, and communicate the financial effects so teams do not continue working to outdated assumptions. In your answer, cover scope changes, labor and material rework, obsolete inventory, tooling, schedule disruption, supplier impacts, baseline control, customer authorization, and updating forecasts and contract estimates. Question 15. How would you analyze supplier cost risk on a Boeing program? I would review supplier commitments, purchase orders, invoices, delivery performance, quality issues, pricing terms, and remaining requirements. A late or financially stressed supplier can create expediting, rework, schedule, and replacement costs beyond the original price. I would assess single source exposure, escalation clauses, contract changes, and the supplier's ability to meet milestones. Then I would quantify likely cost and schedule impacts, include realistic risk allowances, and work with procurement and program leadership on mitigation options. Focus on supplier commitments, open orders, delivery performance, pricing, financial health, quality, schedule, claims, escalation clauses, single source exposure, and translating operational risk into forecast and contingency impacts. Question 16. What is overhead allocation, and what risks can it create? Overhead allocation assigns indirect costs to products or programs using an appropriate base, such as labor hours, labor dollars, or machine usage. Risks arise when the allocation base no longer reflects resource consumption, production volume changes, rates are outdated, or costs are charged inconsistently. I would reconcile applied overhead to actual and approved rates, investigate under or over absorption, and distinguish controllable program costs from centrally allocated amounts. That improves both forecasting and management accountability. Be sure to explain indirect costs, allocation bases, approved rates, absorption, under or over recovery, changing volumes, compliance, and the danger of treating allocated costs as controllable without understanding their behavior. Question 17. How would you distinguish a timing variance from a true cost problem? I would trace the variance to transaction-level evidence, including labor postings, receipts, invoices, accruals, shipments, and period cutoffs. If a supplier invoice arrives late or a planned charge shifts between months, the current period variance may reverse without changing total cost. Conversely, repeated unfavorable labor efficiency or higher purchase prices usually indicates a structural issue. I would review prior month patterns, confirm with functional owners, and change the forecast only when operational evidence supports a lasting impact. Mention accruals, invoice timing, labor postings, receipts, shipment schedules, period cutoffs, recurring patterns, operational evidence, reversal behavior, and avoiding premature forecast changes based on incomplete monthly data. Question 18. Describe a time you found an error in a financial report. In one monthly review, I noticed labor expense was unusually high compared with reported production progress. I reconciled the detail to timekeeping and found charges posted to an incorrect work package after a coding change. I quantified the impact, informed the manager, corrected the allocation through the approved process, and reran the variance report. I also added a pre-close exception check for inactive or recently changed charge numbers. The experience reinforced that early, transparent escalation protects decision quality and trust. Use a concise star. Question 19. Which Excel or analytical tools would you use for cost analysis? I use Excel for controlled analysis, including SUMIFs, XLOOKUP, pivot tables, conditional checks, trend charts, and scenario models. Power Query can standardize recurring data preparation, reducing manual errors. I would reconcile extracted data to the source system, protect formulas, document refresh steps, and maintain version control. For large datasets, I would use SQL, business intelligence tools, or approved enterprise reports rather than forcing Excel beyond its limits. The goal is a repeatable, auditable process, not merely a polished spreadsheet. Mention pivot tables, XLOOKUP, SUMIFs, Power Query, data validation, trend charts, scenario analysis, reconciliation checks, automation, version control, and knowing when system-generated reports should remain authoritative. Question 20. How do you maintain data integrity when working with ERP and financial systems? I would identify the authoritative source for each data element and reconcile interfaces between ERP, timekeeping, procurement, and reporting tools. Controls should include duplicate checks, valid charge number reviews, period cutoff testing, approval workflows, and comparison to the general ledger. I would preserve source extracts, document transformations, restrict access appropriately, and investigate unexplained differences rather than overriding them. Strong data integrity means another analyst can reproduce the result and understand every adjustment. Focus on source system authority, reconciliations, master data, access controls, interfaces, duplicate detection, audit trails, period close discipline, exception reporting, and escalation of unexplained differences. Question 21. A program is trending over budget but remains on schedule. What would you do? I would first validate that the trend is real by checking actuals, accruals, coding, and the baseline. Then I would decompose the overrun by labor, materials, suppliers, overhead, and work package, asking whether schedule performance is being purchased through overtime, expediting, or rework. I would quantify the impact on estimate at completion, identify accountable owners and corrective actions, and present options to leadership. Staying on schedule is valuable, but the cost trade-off must be explicit and controlled. Discuss immediate validation, cost driver decomposition, materiality, forecast impact, owner discussions, corrective actions, risk assessment, management communication, and maintaining schedule cost trade-off visibility. Question 22. What would you do if a program manager challenged your unfavorable variance analysis? I would treat the challenge as an opportunity to validate the analysis, not as a personal disagreement. I would walk through the source data, baseline, calculation, and assumptions, then listen for operational information that may not yet be reflected in the system. If the manager provides evidence, I would reconcile and revise the conclusion when appropriate. If the facts remain disputed, I would document both views, seek independent validation, and escalate material risks professionally while preserving the relationship. Be sure to mention listening, evidence, shared objectives, reconciliation, assumptions, respectful challenge, independent validation, documented conclusions, and escalation only when material facts remain unresolved. Question 23. How do you balance cost control with quality and safety in aerospace manufacturing? I would never recommend reducing a required safety or quality control simply to meet a cost target. Instead, I would analyze the full lifecycle effect of defects, rework, recalls, delays, and reputation damage, then look for efficient ways to meet requirements. That may involve process improvement, supplier development, better inspection planning, or design changes approved through governance. As a cost analyst, my role is to make trade-offs visible, quantify alternatives, and escalate conflicts rather than allowing financial pressure to override aerospace standards. In your answer, emphasize that safety and quality requirements are non-negotiable, use lifecycle cost thinking, quantify prevention versus failure costs, avoid unsafe shortcuts, and escalate trade-offs through approved governance. Question 24. How would you prioritize competing requests from engineering, finance, and program management? I would prioritize requests using business impact, deadline, safety or compliance implications, decision dependency, and effort required. A forecast issue affecting a customer milestone would generally outrank a low-impact ad hoc report, while a compliance concern would receive immediate attention. I would clarify the decision each request supports, confirm data requirements, and communicate trade-offs openly. If priorities conflict, I would align with my manager and stakeholders rather than silently missing deadlines or producing rushed, unreliable analysis. Mention urgency, materiality, customer and milestone impact, safety or compliance risk, dependencies, stakeholder alignment, transparent queue management, and communicating realistic delivery dates. Question 25. Why do you want to work as a cost analyst at Boeing? I want to join Boeing because its programs combine large-scale engineering, long-term customer commitments, and meaningful operational complexity. That environment makes disciplined cost analysis genuinely influential. Accurate forecasts can support better production, supplier, schedule, and investment decisions. I am also attracted to a culture where safety, integrity, and accountability matter alongside financial performance. My strengths in data analysis, variance investigation, and cross-functional communication would help program teams understand risks early and make commercially sound decisions without losing sight of quality. Connect Boeing's aerospace mission, complex programs, disciplined program controls, safety culture, analytical development, cross-functional collaboration, and personal motivation without relying on generic admiration. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.